Hello and welcome to the mid-year 2023 portfolio update for Baird Trust's large cap equity strategy, as well as our more dividend-oriented equity income strategy. My name is John Watkins, and I'm a co-portfolio manager on both strategies. First, I wanted to start off with some big picture comments on the first half of the year. So coming into the year, almost all the prognostications about the stock market and the economy were negative. It seemed as though everyone expected a declining stock market and a recession in 2023. Now, with the caveat that we're only halfway through the year, pretty much the opposite of these predictions has materialized. The stock market year to date has been much stronger than expected, and so far there are very few signs of an impending recession. We have a long-held belief that the future is uncertain and unpredictable, and this year has provided further evidence of how unreliable macro predictions can be. Avoiding these kinds of grandiose macro or market timing predictions is a cornerstone of our investment philosophy. Instead of predicting, we simply aim to concentrate our portfolios in businesses that are durable throughout the economic cycle, because we don't know when the good times are coming and we don't know when the bad times are coming. Because of this, we try to own companies that are prepared for both before they arrive. What this ultimately boils down to is trying to identify businesses with strong and durable business models, attractive balance sheet and free cash flow characteristics, astute managements, healthy corporate cultures, and valuations that make sense. We then aim to own these companies for a decade or longer. Moving on to LCE performance, you can see here on the performance slide, LCE had a strong Q2 in a rising market environment with a gross return of 8.9% and a net return of 8.5%. However, year to date, LCE lags the index by nearly 3 percentage points. So our singular portfolio objective is to outperform the S&P 500 over full market cycles. We believe that the longer the time period, the more informative the performance numbers. There have been many 6-month and even 1-year periods of underperformance over the nearly 30-year history of this strategy. Looking at all other time periods listed from 1 year all the way out to 25 years, we are achieving our performance objectives. This next slide on the left shows LCE's sector allocations versus those of the index. You'll notice that the weightings are intentionally quite different and are a result of our bottom-up company-by-company approach. We believe that outperforming the S&P 500 can only be achieved by looking materially different than the S&P 500. And then on the right are some portfolio characteristics as of June 30th. Finally, we did make one recent change in the portfolio. During April, we trimmed 2 holdings, Apple and Microsoft, by 1% each, and added the proceeds equally to Schwab and Parker Hannifin. Excitement over artificial intelligence is growing, as is the optimistic valuation of many tech companies, Apple and Microsoft included. These optimistic valuations led us to slightly reduce the size of these 2 positions. But even after the trims, these 2 extraordinary companies are still LCE's largest holdings. And then with the proceeds, we added to Charles Schwab and Parker Hannifin. Even though Schwab will have a short-term earnings growth headwind due to higher funding costs for its bank, we don't think that the long-term strength of its business model has been at all impaired. So we used the stock price decline to add to our holding at a substantial discount to our view of the company's intrinsic value. As for Parker Hannifin, we think investors are underestimating the bright future for this company and added to our holding again at a discount to intrinsic value. Moving on to our equity income strategy, starting with performance. The first thing you'll notice is that while the S&P 500 has been surprisingly strong in the first half of 2023, our benchmark for this portfolio, the Russell 1000 value, is only up 5%. So if you look at the top 10 contributors of the S&P 500, all of them would be what we would consider large technology companies, and these 10 accounted for 80% of the S&P 500's return. These would be Apple, Microsoft, NVIDIA, Amazon, Meta, Tesla, Alphabet, Broadcom, Salesforce, and Advanced Micro Devices, or AMD. Only one of these companies, Broadcom, has a dividend yield over 1%, and the only three that are also in the Russell 1000 value are Meta, Salesforce, and AMD, none of which pay a dividend. So overall, these factors have been a substantial headwind to the performance of equity income year to date, which is why the year-to-date performance up 1.9% gross and 1.3% net trails both indices by a wide margin. This recent underperformance now means that the 1-year and the 3-year numbers for equity income are also trailing the Russell 1000 value. However, these ebbs and flows of the shorter term numbers are pretty normal for a strategy that looks materially different than the benchmark, and we believe that the longer term performance numbers tell the full story. On the next slide, I'll just point out a few things in the table on the right, the characteristics. Dividend yield for our equity income strategy is 2.7% at quarter end, well above the 2.3% for the Russell 1000 value and the 1.5% for the S&P 500. Importantly, if you look at dividend growth over the long term, it's quite attractive, compounding at 11.6% annually over the last 5 years. As a reminder, we're not trying to maximize current dividend yield, but instead are trying to balance an attractive yield with very strong long-term growth. And then on the last slide, I'll just note that when you look at our top 10 holdings, there's a nice balance among the names with higher dividend yields but slower dividend growth, and then some lower yielding names but with very robust rates of dividend growth. Again, we think this mix will help us achieve our objectives of both current income and dividend growth over the long term. And then finally, just a note on portfolio activity. After a relatively quiet period over the last year and a half, we made several changes to the portfolio in both April and May. So we eliminated 3 positions, 3M, Verizon, and Kimberly-Clark. We trimmed our positions in Microsoft and Apple. We added to our positions in Charles Schwab, Parker Hannifin, and Pfizer. And then we initiated a new position in Wells Fargo. For more detail on both portfolios' Q2 and year-to-date investment performance, including individual top and bottom contributors, as well as further commentary on both portfolio changes, please request a copy of our written portfolio recaps from your financial advisor. With that, I'll conclude our mid-year portfolio recap. We look forward to reporting our full year results to you in January. Thanks so much for your time.